very pleased and excited to kick off this three-part series delivered especially for you, our business partners. And today's part of the series is called Business Entity Formation, and we're lucky enough to have two excellent speakers join us. Before I begin to mention their bios and a little bit more about them, I wanted to let you know some housekeeping issues. Most importantly, at the end of the presentation, we're going to give you an opportunity to ask our speakers questions. To do so, if you haven't done this with Zoom before, you'll see at the bottom an opportunity to raise your hand. And when you do that, we'll pick you out and then unmute you and allow you to ask your question. So again, that'll be at the very end of the presentation itself. And so joining us this morning is Natalie Spiwak and Jeff Webb. And Natalie Spiwak is the founder and president of Affinity Trust. Affinity Trust properly serves the estate planning and business services needs of Kinecta Federal Credit Union members, providing accessible educational webinars and delivering affordable estate planning and business services provided by experienced and licensed professionals to its members. Natalie's a paralegal. Affinity Trust aligns itself with attorneys at Legacy Planning Group to deliver exceptional legal and business services to Kinecta Federal Credit Union members. Legacy Planning Group is led by attorney Jeff Wegg. Mr. Wegg specializes in business and tax planning for family businesses and entrepreneurs throughout California. His practice ranges from advising on business formations to business operations through sales of companies and business succession planning. His clients reflect the diversity of the California business community, including real estate, manufacturing, media, and entertainment. Jeff earned his JD at the University of Southern California, where he served on the Southern California Law Review. He earned a Master of Laws and Taxation at Loyola Law School in Los Angeles, graduating with distinction. He's also an adjunct law professor at Loyola Law School, where he serves on the board of directors. Certified by the state of California as a tax law specialist, his bar memberships include the state of California, the district, the U.S. District Court, that's the Central District, and the U.S. Task Court. With that, let me introduce both Natalie and Jeff. Please, the two of you take it away. We're pleased to have you.
Thank you so much, Paul, and happy April Fool's Day to you as well. We appreciate the warm introduction, and thank you to each and every one of you who is investing part of your morning with us to learn a little bit more about business entity and business entity formation. The goal of today is really to educate all of you who are business owners and those who would like to become business owners about the importance of choosing the best structure for your business. Because if you don't set up your business properly, there could be tax liability reporting and also employee consequences. So today we're going to go through each type of business entity and, of course, give you information about government regulation, liability protection, and also tax implications for each type of entity. There are a number of different types of entities here in California. We have sole proprietorships, partnerships, DBAs, doing business as, limited liability companies, abbreviated as LLCs. We have C corporations. We also have S corporations. We are going to discuss the benefits and drawbacks of each type of entity during this presentation. Of course, all of our situations are unique and our businesses are unique. So we do encourage you to consult with a professional when it comes to determining the best type of structure for your business. Sole proprietorships. A sole proprietorship is an unincorporated business with one owner. An individual who operates a business on their own is by default a sole proprietor. If you operate as a realtor, freelance, run an online business, otherwise sell goods and services, you're automatically considered to be a sole proprietor unless you've adopted another business structure. You can typically identify a business as a sole proprietorship by the fact that the owner's name is the business name. Although sole proprietorships can also operate under a brand name or a trade name. Suppose you sell homemade cookies at a farmer's market once a month, or maybe you're designing websites on the weekends or doing some casual consulting work on the side. Without any formal business entity formation, guess what? You're sole proprietorship. And Jeff, maybe you could speak to some of the benefits of having a sole proprietorship.
Sure. Thank you, Natalie, for the introduction.
Sure.
This is, folks, I think it's a great lead in to start with sole proprietorships. When we talk about the pros and cons, also for all the other business entities, I'd ask you to keep in mind a couple of factors, and these will apply sort of across the board. Costs, both sort of out-of-pocket dollar costs to start up and run your type of business, and also tax costs, okay? Also keep in mind simplicity, ease of use. How easy is it to form and run this entity? And then on the downsides, particularly think about liabilities. So for sole proprietorships, what are the benefits? Really simple and easy to set up. As Natalie mentioned, you don't need to do anything. If you are engaged in business, you are a sole proprietor. That's about as easy as it gets. When it comes to allocating profits and losses, those are all on you as the owner. There's no separate tax return because there is no business entity. There's no formal entity. It's just you. What are the drawbacks? Well, because there is no formal entity, there's no legal separation between you and your business. So guess what? You are liable for all debts and liabilities of your business operations, okay? Now, related to that, you could also be responsible for liabilities caused by your employees. If you're making deliveries and you hire someone to deliver something and there's an accident, that could trace back to you. So there are drawbacks of the sole proprietorship. Related to that, I mentioned taxes. Because there's no separate tax return, all the income and losses will flow through under your personal return, but you do need to report that. So that's sort of a downside, an extra step for the accounting.
Thank you, Jeff. Partnerships. A partnership is the relationship between two or more people to do or trade business. Each person contributes money, property, labor, or skill and shares in the profits and losses of the business. If you're doing business with another person, you are technically in a partnership. And I'm going to provide you all with an example that will kind of flow through this presentation. Let's say Jeff and I are baking and selling cookies together at the farmer's market. Well, whether we know it or not, we do have a partnership. And so what does that mean? It means we're buying the ingredients together, we're making the cookies together, we're selling the cookies together. And if we don't have a formal agreement in place, we are sharing equally in all the expenses and the income that's generated by selling our cookies. And Jeff, maybe you could speak to some of the benefits and drawbacks of us being in a partnership.
Sure. So yeah, another great example. And keep this in mind. If Natalie and I are going into business and we're selling cookies at the farmer's market, much like a sole proprietorship, we are a partnership by default without even filing paperwork. All right. Now, there are types of partnerships where we can formalize it and file paperwork, and I'll touch on that in a moment. But if we think about just the informal partnership that Natalie and I have, again, very easy to establish, right? What are the costs here? Nothing. We didn't have to do anything other than start business operations. So startup costs are low. Very simple to establish. We didn't have to do anything. There's very limited external regulation. Again, there's no paperwork involved at that level. Now, for tax purposes, It's a pass-through, what we call a pass-through tax entity. This is a great benefit. The partnership itself does not pay taxes. Natalie and I's 50-50 share of profits and losses would flow through to our personal return. So there's no additional entity here. There's no additional tax return. There's no additional filing costs. Those are some pretty attractive benefits. But as you can imagine, there's going to be some drawbacks. Again, because there is no formal structure in place, the liabilities also flow through to Natalie and I. All right. So if we have losses, we're on the hook personally. If something goes wrong with the partnership, there is a concept called joint and several liability. That means, let's say the partnership injures somebody for $100. Both of us are on the hook for the 100. We wouldn't pay it twice, but if Natalie can't pay the $100, I would have to be responsible for it. So there are some pretty draconian rules there with respect to liability, particularly this concept of joint and several liability. And I think, folks, you're going to see as we get down to some of the other entity options, why we might not want to have this type of partnership.
Great. Thank you, Jeff. Doing business as, abbreviated as DBA. DBA stands for doing business as. If you're referred to as your business's assumed trade or fictitious name, this allows you to conduct business under a name other than your own. When you form a business, the legal name of the business defaults to the name of the person or entity that owns the business. That is, unless you register your business as a certain legal entity, or if you rename and register your business with a DBA. So let's go back to our cookie company example. One option for Jeff and I is to file a DBA, and we could name it the world famous cookie company. DBAs are typically filed with the county, and the paperwork usually takes 1 to 2 months. And Jeff, I will defer to you to speak a little bit more about the benefits and drawbacks of us having a DBA.
Sure. So a DBA, it's a pretty neat solution for single owner businesses or small businesses. Let me get into that a little bit. So you can use a name, a formal name for your business, as Natalie pointed out, world famous cookies, without forming a formal business entity. And so that's the paperwork that we file with the county. Basically, you're publishing the name, letting the public know you'll be out there using this name, and then you're off and running once you get the DBA approved by the county. What are some of the other benefits? Significant cost savings. The paperwork involved in the filing is a couple $100. Again, we're not forming a formal entity, so the paperwork involved with the business is negligible, and there's no separate tax return or filing. So again, we've got this very streamlined, simplified structure. Again, very attractive for a startup, a single owner business, or just another small type of business. What are the drawbacks? I think this reinforces these themes I was trying to stress in the beginning. Liability, all right? Because we do not have a separate business entity, we're saving costs and we're creating simplicity, but any liability will flow through directly to the owner, to Natalie and to myself in the event of a lawsuit. Another related issue, a drawback for DBAs, now I'm going to get my DBA, let's say in Los Angeles County, does not prevent someone else from getting a DBA in a different county with the same name. Or, even more likely in my case with my clients, in another state. So world famous cookies could already be monopolized in New York or Florida or Texas. We've got LA County, which is great, but it doesn't give us exclusivity. So if you're going to plan on growing your business long-term, we want to think about some of these downsides.
Thank you, Jeff. And that segues into a limited liability or an LLC. An LLC is a legally separate business entity that's created under state law. An LLC combines the elements of a sole proprietorship, partnerships, and corporations, and offers a lot of flexibility for the owners. You can identify a business as an LLC because its legal name will end with the phrase limited liability or the abbreviation of LLC. And so I'm going to go back to our example of the cookie
Yeah.
company here. So let's say I'm worried about Jeff's vision. He's not wearing his glasses today, but he does wear glasses. And I'm worried that he's not going to be able to read the recipes correctly and that someone could get sick from our cookies and they could sue us for all their hospital bills and other damages. Well, under a partnership, I could be 100% liable for the medical bills. An LLC can help by limiting liability to the assets of the company and protects our personal assets from a claim against the company. And Jeff, I will allow you to go into more detail with the benefits and drawbacks of an LLC.
Sure. Thanks, Natalie. So yeah, folks, again, let's think about those factors we were talking about. Simplicity and cost. Well, let's start with simplicity. A lot of flexibility with LLCs. You are allowed to personalize or individualize the ownership and management structure of the company just about any way you can think of. You don't need, for example, a board of directors. You don't need formal fancy titles like president and treasurer and CEO. That can be owned by a single person and managed by that same person, often called, typically referred to as a single member LLC or a member managed LLC. So lots of flexibility there. Big bonus, liability protection. As Natalie pointed out, now I've got a separate business entity. If the company does something wrong, the liability attaches to the entity, not to my personal assets or to Natalie's personal assets. Okay, that's really important. Even if I'm working as an employee of the company and I goof up the recipes and get someone sick, they're going to sue the company, not me individually, because I was acting for the company. Big bonus or benefit, limited liability protection. But Natalie, I just want to touch on the downside.
Sorry.
Yep. So there are drawbacks. Primarily, I would focus on costs. In California, if you could start an LLC online with the Secretary of State. If you do the online form, it's in fact free, which is nice. There's an annual statement of information that costs about $25. The biggest cost, there's an annual LLC tax, and it's $800 per year per LLC. That's a pretty big hit. If you're a small business, doing stuff on the weekends or on the side, $800 a year that's something to think about. Also, you've now got a separate tax return for the LLC. You're gonna have to pay your accountant or return preparer at least several $100s to file the tax return. And in order to get that liability protection that we talked about, that major benefit, you've got to maintain what they call business formalities. So I've got to open up a separate bank account. I've got to keep my bank records. I've got to keep the income and losses from the company separate from my personal. I've got to treat this company like a separate entity. And if I don't do that, I could lose the liability protection. So extra time and effort, some extra costs, those are the major downsides.
And I think, Jeff, this is also an opportunity to bring up the issue of insurance. So sometimes insurance is another way to help shield against lawsuit claims and so forth, correct?
That's right. A great point. So let's say I sort of measure out those costs and it's going to be a little burdensome for my business. I can just get regular business insurance. Now that might be quite a bit less expensive than all these LLC fees. And that's something to think about. Talk to your advisors or whomever you do your banking or accounting with, and they can certainly help. And then you just do some math. Is it cheaper to get the insurance or cheaper to form the entity? Absolutely something to think about.
Thank you, Jeff. And now we're on to corporations. A corporation is a legal entity that's formed under state law that's separate from its owners. It's made up of individuals, groups, or other corporations that has power to conduct business and to own property, assets, and liabilities. So there are a couple of different types of corporations. There's C corporations and there's S corporations. We're going to begin with C corporations. A C corporation is a legal structure for a corporation in which the owners or the shareholders are taxed separately from the entity. C corporations are subject to corporate income taxation. The taxing of profits from the business is at both corporate and personal levels, creating what's called a double taxation situation. All publicly traded companies such as Apple, Amazon, Walmart, Starbucks, those are all C corporations. So I'm going to bring up our example here. Again, Jeff and I are at the farmer's market and we're selling our cookies and having a great day. And all of a sudden we're approached by the producer of a very famous television show, inviting us to go on their show and showcase our world famous cookie company and try to seek investment from the investors who are on that show. So we're so excited about this opportunity. And we go on the show, and one of the investors, known as Mr. Awesome, loves our world famous cookie company idea, and he wants to fund an IPO and take us public. So of course, we're super excited about this. But one thing to keep in mind, if we do go public, is we would have to be a C corporation. And Jeff is a little concerned about that because he points out that we are going to be double taxed. And Jeff, I'm going to let you speak a little bit more about that concern that you have about C Corp and the tax implications.
Sure. Great, Natalie. Thank you. And congrats on the IPO. So for folks, for those of you who aren't familiar, an IPO is it's an acronym for initial public offering. That's the lingo for if you've got a private company and you want to sell your shares out to the public through a public stock exchange. Okay, so that's an IPO. So we got lucky. So a quick review of the benefits. Again, limited liability, much like I discussed with an LLC. Unlimited number and types of shareholders. And keep that in mind. That's going to come up in our next example. Very attractive for outside investment, because we can accept money, because we can go public, you're more likely to get large institutional investors and other large private investors to put money into your venture. And for tax purposes, the tax on corporations is in fact lower than it is on individuals. 21% federal, just about 9% state level. But I'll get to what that might be a double-edged sword. Okay, so now the drawbacks, as Natalie mentioned, the biggest drawback is this concept of double tax. Let me spend a minute and talk about that. If I have an LLC, remember, or a sole proprietorship or regular partnership, they are tax pass-through. The income and losses pass through the entity. There's no tax at the entity level, and I pay the taxes individually. A C Corp is a separate entity for tax purposes. It will file a separate tax return, and it will owe tax on its profits to both the federal and state level governments. Again, 21% federal, about 9% state and California. So cookie company profits $100, all right? We're going to owe $30 in tax to both the IRS and to our friends at the Franchise Tax Board in California, reducing our profit from 100 down to 70, all right? That $70 is our leftover profit. Natalie and I now want to get that profit out. That's called a dividend. You might be familiar with that term. When Natalie and I receive the dividends, we are going to account for that on our individual returns as taxable income. Now, dividends are taxed at a lower rate than ordinary income. They're taxed at 20% like capital gains, plus probably around 10 to 12% at the state of California level. Another $30 in taxes. The $70 gets reduced down to 40. So we're now paying an effective tax rate of 60%, 30 at the corporate level and 30 at the individual level. That's the double tax, okay? So essentially you're paying 60% in taxes. If Natalie and I just stuck with an LLC, we'd be paying maybe 30 to 40% on the individual level. There's no corporate level tax. The flip side is we can't take our LLC public, right? If we want to go public, we got to go with the C Corp. So that I hope gives everyone a sense of the pros and cons. Some other drawbacks, no personal write-offs like you could on an LLC, lots of business formalities with a C Corp. You have to have annual meetings for the board of directors and the shareholders. There's stricter regulations with respect to raising money and operating and things like that. The big downside is that double tax, Natalie, and that big upside is we can go ahead with our IPO. So let's think about what our options might be.
And I think that also illustrates a good point that businesses can also evolve over time and grow over time. And we may have to modify our structures, to accommodate those changes.
Great point. Yep.
Now we're going to go into S corporations or S corps. An S corporation, also known as a subchapter S, refers to a type of corporation that meets specific legal requirements. The S corporation may pass income, along with other credits and deductions and losses, directly to the shareholders without having to pay federal and typically state corporate taxes. It's usually associated with small businesses, which we define as 100 or fewer shareholders. An S Corp status offers the regular benefits of incorporations, but in C Corps, but enjoys the tax exempt privileges of a partnership. So going back to our example here, Jeff, I absolutely agree with you that the double tax is a problem, a serious one. And I have heard, from actually my accountant that having to elect to become an S corporation might be a solution to this tax problem. Can you go into that in a little more detail for us?
Sure. And your accountant advisor is absolutely right. If we don't want to go ahead with that IPO or it falls apart, and we're not going to go public, we could still be a corporation, but we would engage in some paperwork that's called an S election. For those who taking notes, it's a form 2553. You file with the IRS, and it turns your C Corp into an S Corp. The main benefit, no corporate tax. It's exempt from tax at the federal level. There is a filing requirement, but there's no tax due. It flows through to the shareholders. You can write off startup losses and expenses, and the other, the holy grail, liability protection, just like the C Corp or the LLC. Again, if you maintain those corporate formalities, filing the paperwork, having meetings, etc., which your corporate attorney should be very familiar with, you get that liability protection. Couple of the downsides. Again, less attractive to outside investors, particularly institutional, because you can't go public. It's going to be privately held. Limitations on your shareholders, you can only have one class of stock. Some corporations will have like preferred stock and common stock. S Corps cannot do that, just one class. You're limited on your types of shareholders, as Natalie pointed out, only 100 shareholders. They also must be individuals. All right. They also must be U.S. persons. Foreigners cannot be shareholders in an S Corp. And so those are the main downsides. So if we're not going to take that IPO path, Natalie, I think we take the S election. It's going to save us quite a bit in taxes.
Mm-hmm. Thank you, Jeff. Nonprofits. Okay, so Mr. Awesome got our IPO through and we went public. So now our shares are worth millions of dollars. We love running this business, but we also realize that we want to pursue charitable causes. So I approached Jeff and tell him I'm interested in setting up a nonprofit. What is a nonprofit? A nonprofit is a legal separate entity that's organized and operated for a collective, public, or social benefit. In contrast with an entity that operates as a business, aiming to generate a profit for its owners. Examples of nonprofits include political organizations, schools, business associations, and even churches. Nonprofit entities may seek approval from governments to be tax exempt, and some may also qualify to receive tax-deductible contributions. Jeff, can you share with us some of the benefits of having a nonprofit if we do want to pursue these charitable avenues?
Absolutely. So, and I should sort of clarify here, when we say that a nonprofit's a legal entity, it's a corporation. All right, so we're going to still submit paperwork. We're going to form a corporation. In this case, we have our corporation. We've already got our world famous cookies corporation. We're going to convert it though from a for-profit entity into a nonprofit one. How do we do that? A couple of steps. At the state level, you notify state government. There's some paperwork involved. You're going to prove that you are for public benefit. And at the federal level, quite a bit of administrative paperwork as well. And we will become a nonprofit under code section 501c3. Many of you might have heard of that. A 501c3 just means it's a nonprofit. What it really means, it's a corporation for public benefit. Any profits are donated to one or more charities. And as a result of that nonprofit public benefit status, it's not subject to tax. If you think about it, because it's donating all the profits to charity, there's no profit to tax, but it's sort of two sides of the same coin. So the benefits, federal and state tax exempt status, that's fantastic, right? You still get liability protection for owners, directors, and officers, right? It's still a corporation. In addition, like a regular C or S corporation, there's indemnity or liability protection for the officers and directors. So that's great. And, in the bigger picture, in our case, we already had our IPO. We made all the money we need. We're going to sail off into retirement. We want to give back to the community. We're going to be spending our time and efforts. Now, we're still going to be selling cookies, but the goal for selling the cookies is not for profit. It's to return back those benefits to the community. And that is certainly something that I think would have its own benefits. So those are the real upsides to the 501c3. What are the downsides? In the most generalized sense, paperwork. Administratively, there's a lot of compliance for nonprofits at both the state and federal level. To set them up can be quite burdensome. We do help our clients with this. We typically tell them expect 8 to 12 weeks of paperwork. And then on an ongoing basis, the compliance annually is frankly a little bit burdensome. The good news is there are a lot of tax firms who will offer reduced rates or do pro bono work for nonprofits. There's a whole sub section in the tax and accounting world for these types of entities. And, there is sort of a reason for this. There had been abuses in the past, people saying we're a nonprofit and trying to hide profits and things. So the government oversight is understandable, but be aware that is one of the downsides.
Thank you so much, Jeff, for explaining that. Now we have this breakdown for everyone to see. It sort of summarizes what we've been going over today. And Jeff, I'm going to ask you to just review this with our.
Sure. So Natalie and I put this together. We thought this was a really handy guide to keep in mind, what kind of entity might I want? Well, let's go back to those factors again. Liability. Does the type of entity offer liability protection for the owners separate from the entity or not? Okay. What's the tax treatment? Is it one of those great pass-through entities, or does it pay tax separately at the entity level? And then finally, sort of the issue of simplicity. What's the level of government intervention and oversight and compliance? Okay. So if we start with sole proprietorships, no liability protection. Obviously, because there's no entity there. It's a pass-through because there is no separate entity. Everything's going right under your tax return. The level of government oversight, basically zero, because we don't have an entity. We don't even have a formal name. We're just out there offering the goods and services that we're doing. General partnership, very much like the sole proprietorship, except I've got a partner, so no liability protection. And remember that joint and several liability I talked about. You could be on the hook, Natalie, for my misreading of the recipes if I'm not wearing my glasses. A little bit of additional work on tax treatment because now we've got to split the profits and losses with your partner. Government requirements and oversight, minimal. We're not filing paperwork and there's no tax return. Limited partnership, that would be if we do file paperwork for a partnership. So now there's liability protection for Natalie and I. It's still a pass-through, and there's a little bit of additional paperwork now. There will be a separate tax return for the limited partnership, and there's just an annual filing, so some minimal paperwork. So we call this a little more oversight than a proprietorship or a GP, the general partnership. Next up, the LLC. For those of you who are not familiar with LLCs, one of the most common and popular types of entity choices, and constantly growing in popularity. Liability protection, absolutely yes, the big upside. Tax treatment, typically pass through like a partnership, but you are in fact allowed to choose what type of tax treatment you want, which is sort of an interesting idea, but generally a pass through. So no double level tax, but liability protection. Level of government oversight, minimal, a little bit more than the others so far, but you do have an annual tax return. But this is sort of the best of both worlds. You get the liability protection without paying the taxes and some minimal paperwork. Very popular choice. Now we get to our types of corporations. C Corp, yes, liability protection, but now we've got the double level of tax on a C Corp, and the oversight and paperwork is going to be higher. You've got those corporate formalities, the certainly separate tax returns, those minutes and everything that I was talking about earlier. So I'm pretty high on that scale of government requirements and complexity. S Corp, yes, you get the liability protection. That's great. The S Corp does not pay corporate level tax. It's a pass through. But you've still got those corporate level formalities like a C Corp. So, very common choice. The S Corp, Natalie, as you know, the probably two most common, the LLC and the S Corp. The major difference would be S Corp has a little bit more of formalities, but you get both liability protection and pass through on taxes. So the S Corp and LLC are usually the most popular. Again, we typically do a more in detail analysis of your business or your business plans, but those in my practice, in my experience, are the most common.
Thank you, Jeff. And I think this also, stresses the importance of having a great team. You have your attorney, you have your accountant, you have your wealth manager, your financial advisor, because everyone has to work together, I think, especially when you have a business, to make sure that you are getting all the right benefits, for your business. So I just like to say it's important to have that. If you would like to schedule a consultation with Jeff or someone else from our team, please do reach out to us. And you can do that through Paul Smith, and I'll have his slide up here momentarily. And that way we can talk through your specific situation, because I know we're all different and there's so many things to think about. It's a little overwhelming, but once you speak with a professional, I think it all comes into focus.
Yeah, Natalie, that's a great point. Having the team in place, we obviously recommend going through this analysis before you launch your business. That's really sort of the ideal world. In the real world, that might not happen. Folks, you might already have your sole proprietorship or general partnership up and going. Okay, in that case, great. We can always form a new entity for an existing business operation. So don't let that be an impediment. And if you've already formed a business entity and you think, well, maybe I ought to change this to a different one, guess what? You can convert. If you formed a C Corp and you're thinking, gee, I didn't realize I'm paying double level tax. You can make an S selection and then get away from the tax, the double level tax. You can convert a Corp to an LLC. You can convert an LLC to a corporation. So we can do these after the fact as well. There's a lot of flexibility. Again, we want to get you in early with these decisions, but if you're already up and going and you're thinking, I probably should have an entity in place, particularly for liability, no problem. We can make those changes for an operating business. And again, Natalie, as you pointed out, those consultations with our firm are complimentary. They are free for members of the credit union. We really want to be a resource for you. So just reach out to Natalie or Paul and his team, and we can get started on that.
And with that, what I'd like to do is to move into the final portion of this, which is to address any to address any questions that you might have for us. And then you can do so by going to the bottom of your screen. You're going to see the raise hand there. I'll notice that you've done that and unmute you, and then we'll move forward. So if you have a question, please click on that button and I'll get you unmuted and we can start.
Maybe Jeff, you answered all the questions that people are thinking
Yeah,
about.
I hope so, or maybe created a few more. Paul, while we're waiting for the folks to get their questions in, I was going to mention you had a great point about as businesses grow, income and profits are growing, complexity expands. You can, as I mentioned, change your type of business entity as things progress. And that is something that we work with our clients all the time. So again, you can create one on the go, on the fly for an existing business, and you can change the type of business you have, even if it's already under operations. So something to keep in mind for folks.
Okay, and I'll say to the group too, if you see any hands that are raised, please go ahead and respond to them, unmute them if you would. I don't on this level.
Sure. Yeah, I see here. I see two questions, but I don't have the power to unmute them. So maybe they can unmute themselves. I don't know. Or Frank.
Hi, good morning, everyone. I'll go ahead and handle this portion of it.
Sure.
Paul, if you switch over from the panelists to the attendees, you'll see the hands raised. Adolfo, you are first with your question. Please unmute yourself, and then we are ready to go. Adolfo, go ahead and ask your question.
Hi, thanks for this session. I have a question. I have a nonprofit right now, but I want to know whether I should be I'm a 501c3, but someone mentioned that I should look at a 503. There's like a different nonprofit based on whatever the business is or whatever the income. I'm not sure, but I was wondering if you could speak on a 503 versus a 501c3.
Sure. So Adolfo, great question. So there are different types of nonprofits. It's going to depend on a couple of things. Number one, primarily it differs in your tax benefits. 501c3, you can write off donations. The 503A, I have to go back and check. We don't deal with those very often. I believe that those are typically religious organizations or religious based rather than the more general public benefit, Adolfo. I'd be happy to talk with you in more detail offline about that. So reach out to Paul and his team. We can set up a whole separate call for that. But again, it's going to depend on how specific you are in the public benefit. Again, I believe a 503 is going to be specific for religious based benefits. The 501c3 is a more general public benefit.
Great, thank you.
Sure.
And I do see one now for Ahmad. Ahmad, I'm going to allow you to talk.
John, oh, go ahead.
Good afternoon. Good morning. Question: how can I switch from I have a nonprofit that's designated as a private foundation, and our intention was for it to be a public charity. We do have 501c3 status, but I was told by when I was filing my taxes that we have to do these very elongated tax returns as opposed to if we were just a regular 501c, we wouldn't have to do that.
So, excuse me, Ahmad, so you want to revoke the foundation status and just do a regular 501c. Is that right?
Yes.
Yeah, that's something that we can advise on, but that's going to be done through an election on your tax returns, I believe. Again, that's a little more detailed. I'd be happy to get on a call with you and work with your return preparer. That's something that's typically done on the returns, and a direct filing with the IRS. Happy to advise on that. Again, reach out to Paul. They'll get you in touch with myself, and we can set up a consultation, a free consultation for you. Okay.
Thank you.
Sure.
Thanks, Ahmad. And John, I may have stepped over you. I apologize for that. John Painter, I put you on unmute. You should be able to ask your question. Go ahead, John.
Hi, good morning. Thank you for the presentation. Very, very informative. I have a question about LLC. Isn't it true that you can still be sued personally, even if you're protected by the LLC and have insurance?
John, great question. Yes, you can be sued. But keep in mind, anybody can be sued for anything. The question is whether or not the lawsuit really has legal grounds or legal basis. So if I own an LLC and it sells cookies and I'm selling cookies through my LLC and someone eats a cookie and gets sick, they can try to sue me, but they're not going to get anywhere. If it goes to court, a judge in a court's going to say, you're suing the wrong person, sue the LLC instead. Now, I would have to defend myself in order to get that result, but that person is not going to be able to get my house or my savings accounts. They're going to go after the LLC. Same thing with insurance, frankly. If you own the cookie company and you've got insurance for, let's say, product liability for a bad cookie, someone can sue me and my company. I've got to go proactively notify the insurance company, and then they'll cover the claim. Now, Natalie had mentioned the benefits. So, excuse me, John. So you're right. Technically, yes, I could get sued. It's a question of whether or not that lawsuit's going to go anywhere and have any grounds. If I maintained all those business formalities of the LLC, I kept a separate bank account, I sold the product under the name of the company and all that, I'm going to be safe from liability. It's the company that's going to get sued. So great question. I would just expand on that with, you mentioned insurance. The benefit of insurance, business insurance, and also just like maybe it's called an umbrella policy. Think about this. If I have an LLC, sure, I can defend myself. I got to go hire a lawyer and pay the attorney to defend my LLC in court. If I've got business insurance that covers that claim, guess who pays the legal fees? The insurance company. So I get the added benefit of, I get the LLC protection, plus the insurance will cover, most of the time will cover all my legal fees as well. So, I think that's something, reach out to Paul and his team. They can advise you on those types of things for insurance purposes, but very smart to explore all of your protections, not just the business entity.
Thank you very much.
Yeah, absolutely. Hope that's helpful, John. Good luck.
Yes.
Good question, John. Next, we have Janicia. Janicia, I'll go ahead and allow you to talk. Please feel free to bring up your question.
Okay, perfect. Thank you so much. So first and foremost, thank you guys for having this. It's not only helpful for business owners, but also us as PFAs trying to navigate business accounts that come through. So my question is, I have an LLC and I'm interested in creating a parent company. Mm-hmm. And I initially formalized my business in California, but I now live in Nevada. So I've kind of have this business structure where I'm formalized in California, but I do business in Nevada, and there are some operational challenges there. So I was wondering if we have someone that I could talk to kind of guide me on, should I, register the LLC in Nevada as well? Do I need a separate business license and things like that to kind of make sure that my structure is sound, or if I need to create something new?
Great question, Janisha, and thanks for bringing that up. You can reach out to us again through Paul and Natalie. We advise on business formations in multiple states, including Nevada.
Okay,
we're based in California. We can help with that. More generally, though, really interesting question. You have a number of choices. You could form a new additional entity in Nevada to own the California entity. You could migrate the California entity to Nevada. You could dissolve the California entity and form a new one in Nevada to take over the operations. A lot of different choices, and it's going to depend on your situation. Where are the business operations occurring? Is it something that can be done remotely, or is it like, so to speak, on the ground? Nevada has a lot of attractive features. You know, it's a no income tax state. If you live there, there's a lot of benefits. But if your business operations are in California, you're going to have an entity either formed here or registered to do business in California. So a lot of choices. I'd be happy to discuss further offline. A lot of choices for you, and I think we could probably help you find an ideal solution.
Awesome. Thank you so much.
You're welcome. Yep.
Great question, Janicia. And again, if you would like to talk to Greg in further detail, just give me a call, or anyone, please, if you have further questions or would like to discuss any of these issues in a further degree, please give me a call at that telephone number there on your screen, the 949-338-3332, or feel free to reach out to me by email at paul.smith@kinectawealth.org. That's there as well. Any more questions?
Actually, I have a question, Paul.
Yes.
So, you know, as a business owner, is there a way you can set up a SEP or a solo K to help offset any tax liability? Is that something that you would help with, Paul, or Jeff? Can you shed some light on that?
You know,
I'll
Jeff,
defer
if
to
you could
Paul.
first, yeah, I was going to say, if you could outline that, but I'll say we certainly can help with that. In fact, great question, Natalie, because that leads further to a final comment I was going to make about this, is that, you know, these are always great information, and it's excellent to add this to your knowledge base when you go to these. But what's most importantly, and I find especially for our business members, for those contacts, is to take the next step and try to use some of this information and enact something new that will improve your business and will help you as an individual as well. And the best thing to do, if you reach out to me, I'll put you in touch with the right people who can help with that. It's great to get this information. It's even better to improve your situation using that information, though. Great question, Natalie. Any other questions from those who have attended? Anything else that you'd like to bring up online? If not, again, please feel free to reach out to me directly and we can talk about those one-on-one.
Looks like John might have a follow-up question, Paul.
Yeah, he sure does. Okay, John, I'll unmute you.
Thank you.
You're open.
Just to piggyback off one of the previous questions, if I form an LLC outside of California, can I do business in California? Or how do I do business in California? Do I have to create another entity, or how does that work?
Yeah, John, great question. So you've got two basic choices. If you have a business that is operating in California, and that can be sort of an amorphous type of definition, but let's say I've got a storefront, you know, an old style brick and mortar store here in California, and I want to run it through an LLC for liability and all the other, you know, the benefits that we talked about. I've got two choices. I can form a California LLC to own and manage that business, or I could form an entity outside of California, let's say Nevada. If I form an out-of-state entity, it will have to register to do business in California. And it's going to have to basically do all the things the California entity would do. It's going to have to file what's called a statement of information, which is that $25 fee. And it's going to have to pay that annual tax, that $800 annual fee. And so let's say I have the out-of-state entity, the Nevada company. If I'm doing it just for the California business, it doesn't make sense, because I'm paying both the Nevada fees and the California fees. If it's working in other states, then it might make sense to have just one entity and simplify, for example, the tax returns. But in California, they're going to hit you for that annual tax and what other annual fees are related to it through what's called registering to do business. It's the equivalent of forming a new entity. but it wouldn't have to do an additional tax return. So that's one of those situations, John would be happy to do the free consultation and advise you further. There's a couple choices, and yeah, again, just let me know, and we can reach out to Paul and we can start a conversation.
Thank you. I have the contact info. Thank you.
Great, great.
Okay, any final questions before we wrap up the first in our series? It looks like we have come to an end. So again, thank you for spending your time, especially on Saturday, especially on April Fool's Day. And I'm sure you share in my sentiments about how strong the information is that we have, and you can see how pleased we are with the team we put together to service you, our business owners. Look forward to working with you in the future, and I'll ask for the panel if they have any final wrap up comments that they'd like to make.
I just thank you, Paul, for the opportunity to share the information, and hope folks take advantage of this to, we'd be happy to help them improve their business and become more profitable.
And thank you so much. Appreciate being here and that you're providing financial literacy and education to your members. So thank you for that.
Thank you, Jeff and Natalie. Anyone else? Frank, would you like to add anything?
No.
Oh.
Once again, thank you everybody for taking the time. Please visit kinectawealth.org for webinars such as you got today, future webinars, not only for businesses, but for all of our members on improving their financial well-being. Have a great weekend.
Thank you, Frank. Thank you, everyone.
Thanks,
And
everyone.
as Frank said, please have a great weekend. Look forward to your participation or next in the series. Talk to you soon. Bye-bye.